Welcome to my channel. Today we will talk about a strategy that if you use, you never lose on the stock market. Let's dive in. The Dow Jones Industrial Average, or simply the Dow, is one of the oldest and most commonly followed equity indexes. It was established on May 26, 1896 by Charles Dow and Edward Jones. At its inception, the Dow was calculated at a value of 40.94 points, comprising 12 leading industrial companies. Today, the index consists of 30 large, publicly traded companies representing various sectors of the US economy. The latest value of the Dow as of February 16, 2024 was 38,627.99. Let's take a look at the Dow chart. As you can see from this chart, the Dow mostly goes up over time. It is not a straight line, but if you keep it for a long enough time, you are safe. This pattern has worked for more than 100 years and is still working. We have another index, the S&P 500. It is considered a benchmark for the US stock market. It is a market capitalization weighted index of the 500 leading publicly traded companies in the US. The index covers approximately 80% of available market capitalization and reflects the performance of various sectors and industries. Many investors use the S&P 500 as a benchmark to compare their own portfolio returns and to measure the risk and return characteristics of different asset classes. The S&P 500 has returned a historic annualized average return of around 10.26% since its 1957 inception through the end of 2023. NASDAQ is an acronym for the National Association of Securities Dealers Automated Quotations. It is a global electronic marketplace for buying and selling securities like stocks, bonds, ETFs, and options. NASDAQ started as a subsidiary of the National Association of Securities Dealers and ASD, now known as the Financial Industry Regulatory Authority FINRA. In 1971, as of February 2024, NASDAQ had over 3,700 listed companies with a collective market value of over $23 trillion. Another popular index is the NASDAQ 100, which tracks the 100 largest and most actively traded non-financial companies on the NASDAQ stock market. As you can see from the chart, all the indexes have similar performance. Over a long period, they always go up. But if you try to time the market and constantly buy and sell, you become a casino player and most likely you will lose your money. Stick with a period of, let's say, 5 years, and you will see great results. Now take a look closer at the legendary investor Warren Buffett and his company Berkshire Hathaway stock. We will compare the performance of his stock to the indexes we already discussed. First of all, I would like to mention Buffett's rule that until you sell your shares, you don't make any money. See my short video about that. I put the link in the description below. So don't ever panic if your shares are down. They will eventually recover. And remember, this rule has been working for over 100 years and never failed. Over the 5 years, Berkshire Hathaway stock gained 100%. If you invested in this stock, you'd double your money. The Dow gained 50%, S&P gained 82%. But NASDAQ and NASDAQ 100 outperformed Buffett's stock with 113% and 153% gains respectively. Well-known fact that 3/4 of all mutual funds money managers can't outperform the S&P 500 index. So Warren Buffett is doing very well. So how can we trade the indices? We can use ETFs. An ETF, which stands for Exchange Traded Fund, is a type of investment security that holds a collection of other assets, such as stocks, bonds, commodities, or currencies. ETFs are similar to mutual funds, but they trade on stock exchanges like individual stocks. Index ETFs track the performance of a specific market index, such as the S&P 500. the Nasdaq Composite, or the Dow Jones Industrial Average. Index ETFs are usually passive, meaning they aim to replicate the index as closely as possible, rather than actively trying to beat it. I can provide you with ETFs that track the performance of the Dow Jones, S&P 500, Nasdaq, and Nasdaq 100 indices. One of the most common ETFs that follows the Dow is the SPDR Dow Jones Industrial Average ETF Trust Deer. One of the most common ETFs that follows the S&P 500 is the SPDR S&P 500 ETF Trust SPY. One of the most common ETFs that follows the Nasdaq is the Fidelity Nasdaq Composite Index ETF 1EC. One of the most common ETFs that follows the Nasdaq 100 is the Invesco Trust QQQ. Let's take a look at how closely SPY replicates the S&P 500. It is pretty close, right? So you can buy SPY, and 5 years from now, you will outperform 3/4 of all mutual funds money managers. If you want to outperform Warren Buffett, you buy QQQ. Do nothing for 5 years, and you will be a winner. Isn't that easy? You don't need to read tons of investment books. Just watch this video again. Next Saturday, we'll make a video of how to make even more money by investing in ETFs. Don't forget to like this video and subscribe so you don't miss it. See you next time.